Webinar on the R&D tax credit, and this year we have got some exciting news to share with you about some of the recent happenings as it relates to the R&D tax credit. What we're going to review with you today, however, before we get there, is we're going to, again, as we always do, provide an overview and tell you how broad the definition of R&D is and where R&D is taking place within contract manufacturers. And then a little later on, I'm going to introduce Omar from the Franklin Partnership and let Omar give you a little review of what has taken place in Washington. And then, as always, throughout this webinar, we do want to take questions that you might have as it relates to the R&D tax credit. So let me start by introducing myself. My name's Scott Schmidt. I'm with the Blackline Group, and we are an NTMA National Associate member that focuses solely on the R&D tax credit. And I will be joined today by my colleague Rachel Bishop, who is a director of R&D at Blackline Group. And as I just mentioned, Omar Nashashibi from the Franklin Partnership will be joining us. So, as you all know, or hopefully you've heard, a lot of stuff been going on with the R&D tax credit in Washington, and today what we want to do is explain to you why you should be thinking about the R&D tax credit and how contract manufacturers can qualify. So at a high level, what you want to keep in mind about the R&D tax credit is that the definition of R&D is much broader than what people often tend to realize. At a high level, companies developing and or improving a product and or process can potentially qualify for the R&D tax credit. And assuming that you're doing those activities, you can generate a tax credit which will help reduce your tax liability. And in addition to the current year, where you might be claiming an R&D tax credit, if you've not claimed the credit in the past, you might be able to go back to prior years potentially and generate some opportunity there. And then in addition, on a go-forward basis, assuming you do these activities that meet the definition of R&D, you'll generate credits on a go-forward basis as well. So it really is an opportunity that, as you'll see as we get into this, can create a pretty meaningful amount of money for manufacturers. And as all of you know today, it's not getting cheaper to run a business. You know, there's incredible wage pressure, you know, for that skilled labor everybody's working or looking for. Costs of healthcare are going up. So anything you can do to drop more cash to the bottom line is a good thing. And this is an opportunity that up to this point has benefited many manufacturers in the association and across the country. But because of these changes that are going to be taking place starting in 2016, there's going to be tons more companies that are going to be able to benefit from the R&D tax credit. So with that being said, let's dive into this. And again, what I'm going to do is give you an overview of the opportunity. Rachel's going to talk about the definition of R&D and the costs that qualify. We're going to run you through some case studies. We are going to then give Omar the opportunity to talk about what's been going on in Washington, and then we will also talk about documentation and again take questions. And if people have any questions that they want to ask, we certainly don't need to wait until the end of the webinar. You can type those in and send them in to Kelly, and Kelly will be able to read those off to us as we have them. So with that being said, just to make sure everybody's clear on what we're talking about here, we are talking about a tax credit versus a tax deduction. So you're going to deduct all the costs associated with running your business, and then in addition to those deductions, a subset of those same expenses are also going to generate you an R&D tax credit. So you, in a sense, you're double dipping here. You'll deduct your costs, and then you'll also generate an R&D tax credit, assuming that you're doing the activities that qualify. And then the thing to keep in mind here is that a tax credit's actually worth more to you than a deduction. Deduction's worth what your tax rate is. A credit is a dollar for dollar reduction of your tax liability. So where is R&D taking place within a business? Well, first of all, again, just keep in mind that what the credits and incentive provided by the government to incent businesses to invest back in the business, hire people, implement automation, technology, and do all the things that you need to do in order to compete more effectively on a global basis. So at the high level, activities associated with developing and or improving a product and or process, and you'll hear us say this many times throughout the webinar. And within the NTMA, within contract manufacturing, a lot of companies like yours don't have your own product line. A lot of time people think R&D only takes place in those companies that have their own product lines, but as you all know, there can be a lot of innovation and figuring out problem solving that's required in the contract manufacturing world. And so most of your R&D is going to be process related R&D. And any type of business structure can generate a credit. Doesn't matter whether you're a C Corp, S Corp, LLP, partnership. If you're doing the activities that meet the definition of R&D, you can potentially qualify for the R&D tax credit. Credit's been around for a long time, 35 years now, so nothing new. It's not a tax shelter. It's historically a tool that's been used by all the large companies, the Fortune 1000 larger companies that work with the big four accounting firms, have departments of people that specialize in different types of tax credits, including the R&D tax credit. So they've been getting the advice for a long time. But it's really the small to mid-sized businesses that historically have not been pursuing the credit. If you look back, in say like the last, say 8 to 10 years or so, more and more of the small companies have begun to take advantage of the credit because information about the opportunity, like we're doing today, has become much more common. So while you still have a lot of the small to mid-sized businesses utilizing the credit today, you still have a lot that still are not taking advantage of it, whether it's because they're not getting the advice, whether they don't believe they're doing R&D, and of course, as a lot of you S-Corps know, you have been limited from using the R&D tax credit, and that's one of the exciting changes that we'll talk about later about what Washington and Congress just did in order to make the credit more available to more companies. Every year there's about $8 to $9 billion of R&D tax credits that are claimed by businesses in the country. Of that amount, 60%, 2/3, go to the Fortune 1000 larger companies, yet small businesses make up the majority of the companies in the business, or in the country. 90% plus of the businesses in the country are small to mid-sized companies. So, but the point here is that there's a lot of companies still not taking advantage of the credit. So where is R&D taking place within a manufacturing company or a contract manufacturer, job shop type business? Well, if you have that org chart, that formal org chart with an engineering department, design department, that's good indication that R&D is probably taking place, but it's not necessary to have formal names, titles of individuals. As long as the activities are taking place within a business, then you can qualify for the R&D tax credit. And the key to effective use of the credit is really understanding this area of tax. It's a very subjective, very gray area of the tax code. And so the key is being able to apply it to all the different people within your organization and knowing how to apply it, how to document it, capture it, and so forth. So with that being said, what I'm going to do now is turn the call over to my colleague Rachel Bishop. Rachel is going to run you through the costs that qualify for the R&D tax credit and or that typically generate a company's R&D tax credit, and then she's going to go through the 4-part test, which is the definition of R&D, and then at that point, if people have questions, they can type them in, and we'll be happy to answer those questions. So with that being said, Rachel, I will turn it over to you.
All right, thank you. So what I will do to start is I'll talk a little bit about the different types of costs that qualify for the credit. In general, there are 3 buckets that can be included: the wages of the people participating in R&D, the supply costs associated with development, and then any third-party contract research expenses related to the development of a project. Those are the 3 general categories of costs that you can include. when we talk about labor, we're talking about the people that are directly involved in the research. So that'd be the people that are developing the process, that are even developing the tooling or the fixturing, designing or developing. When we talk about supervision, we're talking about the people that are directly overseeing the people that are directly performing the research, and then you can also include those that are directly supporting the research. So you've got, production workers that you're pulling in to run prototypes, for example. They're not so much conducting the research as they are supporting those activities. So all of those types of costs can be included from a wage perspective. The wages can be the salaries, plus bonus, overtime, does not include fringe benefits, but whatever's taxable to the employee. From an ownership perspective, an owner's W-2 wage would be includable. The supply costs, in general, it's those costs that get used up or consumed during development. Could be scrap material. It might be a fixture that was developed that didn't work. There's a lot of different types of supply costs that have potential. And then the contract expenses, if you're paying a third party to perform some sort of service related to the development, those are the types of costs that can be included from a contractor perspective. You do have to retain the rights to whatever it is you're developing, and you have to be at risk in the development. So those are a couple of key things related to the contract expenses, but those are the three types of costs that a company generally can include. Primarily, the wages are usually the biggest expense. So that's a little bit about the cost, but let's talk a little bit about the activities that can be included. So you're looking to include the costs related to certain R&D activities. Those activities, as Scott mentioned, the definition is a lot broader as what qualifies as an R&D activity. You just have to be meeting these four criteria that are listed here, which it says conducted for a permitted purpose. You have to be trying to resolve technical uncertainty, undergoing a process of experimentation, and you've got to be using one of the permitted sciences. So those are the four criteria. We're going to go through each of those in a bit more detail. Just kind of a key, though, is anytime a company is developing or improving a product or a process, then the chances are there's likelihood that can qualify for the credit, as long as the other tests are met. So let's talk about this permitted purpose test. So this is the goal of the project. When a company is developing a product or developing a process for a product, that's an example of meeting the permitted purpose test. The test says you have to be intending to create or improve a product or process. This is not just the new to the world type of stuff. It's the definition is looking for an evolutionary type development. So, not just new to the world, new to you, where you're making these, evolutional type improvements on your different products or processes. This kind of incremental improvements over your competitors is what the incentive is all about, trying to keep us as competitive as possible by encouraging, not just the revolutionary type of development, but, continuing to get better and better, smarter, faster, and automated in what we're doing here in the U.S. So that is the goal, is to try to make those types of improvements. So that's the permitted purpose test, again, trying to create or improve a product or process. The second test is technical uncertainty, and this is basically talking about, you have to have unknowns about creating or improving that product or process. So your goal is to create a process. You can't know exactly how you're going to do it. You can, however, be confident that you're capable to do it. So you're able to do it, but how are you going to do it? What methodology are you going to use? What's the appropriate design going to look like? Those are the types of questions that fulfill the technical uncertainty test. You might be looking at different materials, different processes, it might be feeds and speeds, it might be different blades, different fixtures, different tool designs and configurations. All of those different methods or design uncertainties fulfill the technical uncertainty test. So that's the second test. The third test is the process of experimentation test. And what this is saying is because you have those uncertainties, you're going to evaluate different alternatives. You might do prototyping, you might do testing, you might just do CAD modeling or any sort of simulation type efforts to figure out those unknowns. You can even just be doing trial and error. So we're going to try this and see if it works. If it doesn't, we'll try something else. All of those are examples of evaluating different alternatives. You're going to have things that don't work, and you're going to have failures, and this is where those failures get rewarded. So we're able to get some of those dollars back in terms of an R&D tax credit. So again, that's the process of experimentation where you're evaluating the different alternatives. Okay, and then the fourth test just says that while you're performing that experimentation, you're relying on the hard sciences. So that's going to be your engineering sciences, computer sciences, the biological sciences, any of the physical sciences will fulfill the technological and nature test. So that is the four-part test. Again, all four of those tests need to be met in order for a project to qualify as R&D. And what happens is once you identify the qualifying projects in accordance with this definition, then you look to the cost and try to identify the costs that are incurred from a wage, supplier, contractor expense during the development phase. So that is the definition and the types of costs. I'll stop right there and see if there are any questions.
So, Kelly, how would people ask questions? Do they type them in, or do they raise their hand and we open up the line? How does that work?
If people want to go ahead and type questions in on their side navigation bar, that should be able to pop up, and you guys can kind of see them as you're going along, and you can answer when it fits in.
Okay. All right. So as of right now, I don't see any oh, I see one question. Will this PowerPoint be available? And the question is, or the answer is yes, it will be at the end of the presentation. Is my contact information, and you just shoot me an email, and I'll be happy to send it out to you. There's another question. What if your company builds prototypes as a service? Rach?
Yeah, so your customer provides you with a drawing or a component and asks you to develop a prototype. There is potential for that to qualify. If you're developing the process to make that prototype, as long as you're retaining rights to that process, and as long as you're at risk in that relationship, then you're going to be, that's going to be your qualified research. As long as, again, you got to meet all four of those tests. So you also have to have uncertainty and go through experimentation or evaluate those alternatives to resolve the uncertainties. So yeah, so definitely the prototyping service has potential to qualify depending on how your contracts are set up with your customers. And then the next question I see, I was just going to say the next question is related because it's asking about clarifying the rights being retained. So I thought I'd dovetail that in. Basically what that's, when you're talking about the rights, to avoid you and your customer or you and your vendor from both claiming research credits, they've got these rules in place that basically say who has the rights and who has the risk. So one of you has the rights, one of you has the risks, that person is going to be the one that is able to include the research. So the rights, you don't have to have exclusive rights. You can be sharing those with your customers, but you have to have substantial rights. You've got to have rights to whatever it is. Generally in custom manufacturing, we're talking about rights to the process. So your customer is providing you with a drawing of their part that they've designed. Well, that's their business component. Your business component is the process that you're developing to make that part. So, and generally, my experience has been that most companies are retaining the rights to the processes that they're developing. They may share pieces of that with their customer or all of it, but they're not giving up the rights to the design of their processes. So I think that's a pretty good stopping point to answer that question, Scott, if you want to look at the other ones.
Yep,
or...
okay. Yeah, great. No, well, let's keep moving on for right now, but let me just build on, Rachel mentioned you have to have rights and you have to have financial risk. And what determines your financial risk is how your contracts with your customers are structured. If you are well, we've seen in the manufacturing world and most of the companies like yours, 98% of your projects are on a fixed fee basis. And your customers come to you, they need a quote, you quote them a fixed price, and you don't get paid until you deliver. And so it doesn't matter whether you actually did lose money on a contract or if you made money, it's just were you potentially at risk. So with fixed price contracts, you are at financial risk. And then as it relates to the qualifying costs associated with that project, it's not the potential costs that qualify for the R&D tax credit aren't just any time or costs associated with a potential overage. A project doesn't have to go over budget to qualify for the R&D tax credit. It's all the costs throughout that project that qualify, assuming that they meet the definition of R&D. So again, in your industry, most of the companies that that we work with, by far the majority of their contracts are fixed price plus, and therefore they're at risk. And then the other point I wanted to comment about is about what is process R&D, because that's where most of your R&D takes place. A lot of times people think process R&D is when you buy a new piece of equipment and put it in on your floor. And there certainly can be some time associated with evaluating and researching new equipment, and then the time spent getting that process set up on your floor. So that is certainly one example of process R&D, but that's not nearly the majority or where most of your R&D is. Most of your process-related R&D you're doing every day. Every time you see a new component, or and you get a RFQ from a customer, and you have to have your programmer, engineer, designer do some CAD work. You could even start before that with a technical sales conversation with a sales engineer or an owner, just somebody who's working to define specifications. But that is all process R&D. And so when you think about in your shops, a very easy high-level way to think about it is what we often see in shops like yours is 50 to 60% of all work is repeat work, but then you have another 40% or so roughly that's new work. And you can just at a high level again assuming there's no changes to those repeat projects, you're really not doing any R&D because you've already figured it out. But it's all those new projects that you take on and or changes to existing projects that you've had in the past where R&D is taking place. So, and that's going on every day. So depending on the size of your shops, you take on hundreds, if not thousands of projects per year. So you are in fact doing R&D pretty much every day within your business. So with that being said, let's just keep moving on, and then we'll stop in a little bit and take some more. We'll take some more of those questions. So what we have in this section is just a whole bunch of case studies that we like to throw out there. In the interest of time, we are not going to go through all these case studies. I put a bunch of them in there so that if people do want the PowerPoint, you have something that you can look at on your own. But there's a couple things we want you to get out of these, and all these case studies are all NTMA members that we've worked with and or currently work with, and you can see the type of business that they're in. You'll see some dollar amounts. You'll see, in some cases, you'll see only one line, which means last year we worked with the company for the first year, where others like this first one, you'll see a credit amount for 2014, and then you'll see a total number from from us working with them for a number of years. And the point of these cumulative numbers is what I said before, is that over time the credit amount can add up and be a pretty significant amount of in many cases. And then we give you an example of R&D that was taking place within the company. So we just wanted to give you give you an idea of a project the company was working on, what roadblocks they were running up against, and then how they resolved that uncertainty that they had. So again, in the interest of time, we are absolutely not going to read these to you, but you can see that these are all precision machining companies, stampers, fabricators. They're in the plastics, tool and die. It doesn't matter, what business that the company's in. If they're doing the activities that meet the definition of R&D, then they can qualify for the R&D tax credit. So a number of these, you'll see there's just that one number for 2014, which means they pursued the credit for the first time last year, and then you'll see some of those other slides where there is a cumulative number and showing what the number can add up to over time. So again, in the interest of time, we're not going to sit and read each of these to you, but I'd encourage you to if you do get a copy of the PowerPoint, to go through these, and the point of giving you these is so you can, look at them and say, hey, maybe we're doing something kind of similar, give you something you can relate to, and give you some indication of should you be looking at the R&D tax credit, and maybe if you're already taking advantage of the credit, are you maximizing the opportunity? So if your company can answer yes to any of these questions, you're very likely doing R&D and should be at least evaluating your opportunity. If you do have an R&D department, design department, engineering department, product development department, very strong indicator that R&D is going on. Again, you don't need to have those names, but if you do, you're likely doing R&D. If you provide design, engineering, or testing services to your customers, and or you're contracting out those services from other companies, then there's clearly R&D going on. But then you have to look at the contracts and find out, is it yours, is it your customers, or vendors, or is it a situation that's also very likely that both companies could have both have R&D taking place. Any company manufacturing a product is doing R&D. Very few companies these days, are not looking to make stuff better, faster, and cheaper. Because if you don't, you won't be in business a long time, because there's just too much global competition. So you got to be on top of your game, and most companies are just always looking how to get better. And if you have applied for and received patents, certainly not necessary to claim an R&D tax credit, but it's good support just to show that you're a company that's innovating and really trying to push the envelope a little bit. This is a long list, different examples of R&D taking place within a business or a contract manufacturer. Again, at a high level, develop, improve product or process. But anybody who's doing that modeling, prototyping, working with different materials, different shapes, different technologies. Anytime you're trying to figure something out, a lot of that can qualify for the R&D tax credit. A couple of the bullets on here that are more implications that R&D is taking place versus them actually qualifying. Where the fourth bullet at the bottom, it talks about adding new equipment. The cost of the equipment or machinery itself is not going to qualify because you're depreciating that. But as I stated earlier, there certainly can be time associated with researching new equipment, the time spent getting it on the floor, programming, till you are ready to go to production. So that's more an implication that R&D is taking place. And likewise, the last bullet, improving or building a new manufacturing facility. Again, the cost of the facility does not qualify, but by virtue of the fact that you're either building a new building or adding on, probably means that there's some enhancements to manufacturing processes, whether new or improved. So again, just to give you some things to think about that might, in your business, that might be qualifying. So what do you need to determine? When you're looking at the R&D tax credit, three things you want to look at. First and foremost, can you generate a meaningful credit that at the end of the process is going to give you a good ROI? Or in other words, is it going to give you enough cash to get your attention and make it worth your while? Number two, if and when the credits can be used, because just because you can generate a tax credit does not mean that you can automatically use the credit. However, as we're going to talk about in just a few minutes, some big changes for 2016 are going to make a lot of companies drop more money to their bottom line because they're going to be able to use the credit. And then third, can you document and support the qualified research expenditures that you are identifying to generate an R&D tax credit? So what's the key to maximizing the R&D tax credit? We've been doing these webinars for the NTMA for a long time now. We've been in business 14 years. 14 years ago, nobody knew of the R&D tax credit. It was then, still is a specialized area of the tax code, very subjective. Unless you work with it a lot, it's hard to get comfortable with and know how to apply it. And especially in the contract manufacturing world, where your R&D is not product related, it's process related. But now, fast forward 14 years to today, and because of events like this, articles, on the internet and magazines, there's a lot more education, a lot more people know of the R&D tax credit. What we also see today is that a lot of people do, claim an R&D tax credit on their own, or they take what they call a calculation approach, where they internally identify what they believe qualifies for the R&D tax credit. Then they take that number, they give it to their accounting firm, and then their CPA crunches a number, and they claim a credit. And kudos to them, they are claiming a credit. But in our experience, the majority of the time when companies drive this process internally, they're usually leaving dollars on the table because, again, they just don't have the comfort level that an expert does, and they end up not maximizing their opportunity. Versus the approach that a firm like a Blackline Group or any other external resource who specializes in the credit, it's a process where somebody who's very familiar, understands this area of the tax code forwards and backwards, they will come in, they'll hold your hand, raise awareness, educate you about what qualifies, challenges you when you say you're not doing R&D, because we hear this all the time in the contract manufacturing world. We hear people say, we don't do R&D, we just get a drawing from our customer. And as you know, business isn't just that simple. Even though your customers give you a drawing, you still have a lot of figuring out to do. So you have somebody who leads the process, tells you where all the R&D is, creates a methodology, creates all the documentation to support the claim, does the calculation, and then works in conjunction with your CPA to make sure that you're getting the maximum benefit. Most today, again, almost all the small to mid-sized CPAs now know of the R&D tax credit, but most of them still don't have the client base where they get it, work with it enough to get really good at the R&D tax credit. So what you see a lot of the times, or the majority of the times, is a firm like a Blackline Group who only does one thing, and that's the R&D tax credit. Work in conjunction with your CPA firm to make sure that you are getting maximum benefit of the credit. Okay, so now I'm going to take a break, and I am going to introduce a gentleman who you are all very familiar with, our friend Omar Nashashibi. And the only thing I want to know from Omar before he starts is where he is sitting right now, because at the beginning of the week, Omar was sitting by a pool in Cabo San Lucas celebrating his anniversary, and that was like 3 days ago. And now I know that, I want to know, is he still by the pool, or is he shoveling snow? So Omar, welcome, and what's the answer?
Don't trust me, don't I wish I was still in Cabo. My 4-year-old, we dropped him at school today, and he went from sandcastles to snowmen in 12 hours, and I think that was a little bit of a shock for him. So we are back in D.C., and the city was a nightmare last night getting home, and it's going to be pretty bad this weekend for us, by our standards, not by anything in the Midwest, of course. But thank you again for the time. Quickly to talk about what's going on in Washington, D.C. with regards to the NTMA tax priorities, specifically the R&D tax credit. This has been a really, really busy few months for us, rather, here in Washington. As many of you know, I'm one of the lobbyists for the NTMA in Washington, D.C., and have been now for about 7 or 8 years with the Franklin Partnership. And one of the top priorities for the association has consistently been working on specific tax provisions. We actually have seen an increase. We just completed our annual survey at NTMA, and it shows that our members increased the usage of the R&D tax credit by about 11% last year over year now, to about 55% of our members are using it. So we're really excited to see that, especially as some of the things Scott mentioned earlier, we're seeing the word spread about it. But in Washington, D.C., they did finally get the message in a couple areas. Between Thanksgiving and Christmas or so, that quick month right in there, we had a number of major developments. We were able to make the R&D tax credit permanent for the first time, and that's a big change for us after Congress kept dealing with it and extending it at the last minute. We also were able to make Section 179 equipment expensing permanent and extend bonus appreciation through 2019. And with regards to the R&D tax credit, one of the things that lawmakers really saw in it was that there are a number of different size companies, and I think that's been an important thing that Scott's been presenting, that really do take advantage of R&D. It's not just the Boeing and the GE who we lobby with consistently. We're one of the leading members of the R&D tax credit coalition, and in our efforts in that group, they love Microsoft. All those companies love seeing us in the room because we truly represent small, medium-sized businesses. And one of the major impacts there is, yes, it's permanent for the first time in its history, the R&D, but looking forward, this is going to give you some clear stability, and that's why we hope to see the number of our members that use the R&D to increase next year, as for the first time really in the last 30 some odd years, you have some predictability in the tax code. You know what your investment's going to be, you know your outlays through 2019 in terms of your tax liabilities, whether it's for purchasing equipment through 179 and bonus that you can in turn use for your R&D activities, or that will be generated as a result of that into commercial activities. There's quite a bit there. Looking forward for the next step, we did extend the R&D as it was for all of 2015. We did make it permanent at 14%. An important point that I think Scott gets into quite often is the AMT. Many of our members are still trapped under the alternative minimum tax, and not many companies really recognize that initially, and that's been a real barrier for a good number of folks to be using the R&D tax credit, among other deductions as well and credits. So now that we have that, you're able to build up your AMTs and count those with your R&D, and Scott will get into that as well a little bit more. But that was an important provision, because ultimately when tax reform does happen, they will readdress the AMT, but until we get to those points beginning in 2017 and later, we are still stuck with an AMT, and Congress is trying to do their best to find workarounds. In mentioning the tax reform, if it does happen, and a lot of people are hoping that some of it will be taken care of this year, but 2017 would be the big push. And in that, on the R&D, the effort is going to be to increase it from 14% to 20%, and also make it the alternative simplified credit, take the ASC up at 20%, but they're going to get rid of the base credit. And again, I'm not as technical as Scott and Rachel, but in this method of thinking is that from Congress's standpoint, you don't need to use the base calculation anymore. You don't need to go all the way back to the 80s to keep track of your R&D. And just even a transition, they literally almost made this transition in November. We were lobbying on it, and they all of a sudden said, okay, effective January 1, 2016, there will be no base method. And that did send some shockwaves through a few folks. But it's got to say, if you're doing the base method, most people today have the data to go back 3 years and under the alternative simplified credit. And we highlight this just so you know where Congress is thinking in the future. Those of you that are still using the base calculation method, I deferred over to Scott and Rachel, but know that it is in the future for Congress to get rid of that, enhance the ASC in the next round, and build upon making it permanent right now as we look at new tax reform. So this was really helpful, and Scott and his team were also great with our work over at the R&D Coalition, giving us some background points and some of the technical changes to that section of the code. So there have been a good number of changes in this area. We do encourage our members to contact Scott, as he's done with some of our other association clients. But there's a lot of support for this in Washington, and this was a really big win from the legislative side.
All right, Omar, thanks for that. Now, we're doing really good on time. You want to give a little bit of an presidential update and what you're seeing, and you want to give some predictions?
Sure. No, happy to do it. And, you know, my mother-in-law was here at the house taking care of our 18-month-old when we took our other one to Mexico with us, and she got back and said, so what do you think of all this? What's with the Republicans? I said, well, yes, there's a lot of anger out there, but perceived anger is typically that it's the angry white man. It's not that, and obviously there is certainly that sentiment, but it's been going on for a while. The anger, the frustration you're seeing are generally coming from women these days, those that believe that they did everything they could, they did everything right by the family, they went and took on an additional job or in addition to what they did around the house, and everything that they were told about the American dream no longer exists the way they were told it does. And if you look at polling from 1986, it said 11% of the people believe that the American dream was not alive and well. But today, 33% of people believe that the American dream is not alive and well. And when you look at women, it's over 40%. And as you segue into the Donald Trump phenomenon and conversation that's still continuing, which no political analyst thought we'd be still talking about Trump the way we are right now, a lot of that is really just capitalizing in being and seeing an opportunity to really drive and allow people to vent that frustration and anger. So he and Bernie Sanders aren't necessarily saying all that different things. Many of the supporters have enough of the similar frustrations they wouldn't vote for one or the other. But as you're seeing, the Trump phenomenon is going to continue. Rubio is what most establishment folks are hoping will be the savior. I have concern about how deep and Rubio is in terms of policy and his preparation when it comes to tax time, when he gets targeted a bit more. Christie's certainly doing very well in New Hampshire. Kasich's getting a little bit of a bounce, so I would watch Christie a bit more than even Rubio. I've just got a bad feeling about how he does the next few months. But also the Cruz battle is no question going to continue between him and Trump as they fight for the same people on that side. And I'll leave Hillary as it is. Hillary ultimately, I think, will take that and be the Democratic nominee at least.
Okay, all right. Well, that's fantastic, Omar. Really appreciate you taking the time to join us today. You and John do a great job on behalf of the association, and we'll let you get back out to shoveling the driveway.
All right, thanks so much.
Thanks for joining us. All right, so Omar just gave us a great overview of what's going on in Washington. Okay, so now we're going to just dive a little deeper on those big changes that are going to be available to people starting in 2016. So we still got to get through the 2015 tax year, which is what everybody's looking at, but 2016 is just the floodgates are gonna open. It's gonna be really a game changer for a lot of NTMA members. As Omar mentioned, he talks to a lot of members, so do we. Every year I tell a lot of people, well, you can generate an R&D tax credit, but you can't use it, then there's probably not a whole lot of benefit to pursuing it at that time, although you can carry credits forward. But anyway, so the major change, one of the two major changes, is that eligible small businesses will be able to claim the credit against the alternative minimum tax. And again, this is starting for activities starting after December 31st, 2015, so basically at the beginning of 2016. So everything you do now will go towards your R&D tax credit claim for 2016, and as long as your business's 3 prior year average is less than $50 million, you will be able to apply that credit against the alternative minimum tax, and that's just a big thing. The other pretty nice change or enhancement to the credit is that certain startup companies are going to be able to offset their FICA or payroll tax with an R&D tax credit. So as you know, a lot of times young companies don't have tax liabilities because they're investing everything back into the business, revenues haven't ramped up yet, and therefore costs are more than sales, and therefore no net income, no tax liability, and thus not a use for a credit. However, starting in 2016, Congress got it right again, and they said you can now take those credits you can generate and apply it to reduce your payroll tax, and thus allow those companies to put that cash back in their pocket. So then when looking at the companies that are going to be eligible for that provision, and quite honestly, you don't see a whole ton of new startups in manufacturing. You tend to see more in like technology and software, and but of course you still do see some, and those companies that are going to qualify need to have annual sales less than $5 million in revenue. They will be limited to offsetting their payroll tax by $250,000 per year, and they won't be able to claim that credit for more than 5 years. But again, this is just going to be a huge boon for a lot of those young startups. And then just a couple other things that are legislative related. Omar mentioned there's a couple different calculations. There's the regular calculation that has been around for 35 years, and then Congress came out with something called the alternative simplified credit. The difference being that the regular credit is a little more lucrative, but you have to go back in time to establish a baseline, and for older and more mature companies, sometimes that's back to the mid-1980s if you were around then. The benefit of the alternative simplified credit, even though it's a little less lucrative, is that you only have to look at your 3 prior years, and just about every company today is going to have some kind of documentation from your 3 prior years just because of technology. So then with that being said, the big news and this was back in late 2014 now, is that if you wanted to, historically, if you wanted to go back and amend your prior years because you had not taken advantage of the credit in those years, you could go back and amend, but you had to use that regular calculation, which was, again, a little more complicated or, required more documentation that sometimes didn't exist. But the change, Congress said that you could now use the alternative simplified credit on those amended returns, which just means it's easier for companies now to go back and amend because they can now use the alternative simplified credit. And then if Omar continues to make the change like he's making there, they'll raise the rate on the alternative simplified credit up to 20%, and it's going to be another fantastic opportunity. And then the other change, and it's actually not even a change yet, it's still a proposed reg, and there's probably not a lot of software development in your world anyways, but I just wanted to throw it out there. About a year ago, Congress came out with a new proposed regulation that narrowed the focus of software development. A lot of times Congress or the IRS will say everything is internal use software, which doesn't qualify for the R&D tax credit, but in reality, a lot of stuff is not internal use, and so some companies would get challenged by the IRS, and even though what they're doing actually did qualify, well, these new proposed regs gave more clarification or narrowed the focus of what was considered internal use software, and that's really helping a lot of those companies that have software initiatives going on, which can also be taking place within manufacturing, by the way. Okay, so I know there's a couple questions around documentation, and we talk with companies all the time, and a lot of times they'll say, well, we can't pursue the credit because we've not been pursuing the R&D tax credit, or we've not been documenting our R&D activities. And the reality is again, most companies today do have data. It does exist. It may not be in the perfect way that you can just punch a button and everything spits out from the computer. But today, companies have ERP systems, time tracking, project tracking, emails with their customers. This information does exist. So my advice to companies would be, don't self-assess and say, nah, I can't pursue the credit because I've not been tracking my time. Because what we usually find is that companies do have enough information to begin to claim the credit, and then with that raised awareness that they now have, they'll do a better job on a go-forward basis, and it all just gets a lot easier. So reading the small print, as we talked about earlier, the opportunity is not just in your current year, but if you've not claimed the credit in the past, you can go back to your prior open tax years, which as a rule of thumb is 3 years, and there's some instances where you can actually go back more than 3 years. And as I said about, on the previous slide, Congress made it easier to go back and amend because of that change about being able to use the alternative simplified credit on those amended returns. The R&D tax credit cannot reduce the federal tax below the tentative minimum tax or the alternative minimum tax for just 1 more year. And then, as we've been saying numerous times now, that all changes in 2016. So next year, I'm going to be able to take this this bullet off the slide because it won't be in effect anymore. If you can generate a credit but you can't use it, you don't lose it. Federal credits can be carried back 1 year and forward for 20 years. And many states have state credits. About 40 states do have a state credit. So depending on where you're located, you'll get potentially a benefit from both the federal and state R&D tax credits. So, with it being the beginning of the year, at a minimum, evaluate your opportunity. It's 2015, or you're starting to do your 2015 taxes. As you're getting into that and you've not claimed the credit in the past, do some evaluation, assessing, and see if you do have an opportunity. While you're doing that, look at those prior years and see if there's something meaningful that makes sense to pursue. Not everybody has a great opportunity that makes it worthwhile to go back. A lot of companies will just get a lot of benefit from starting in the current year and claim the credit on a go-forward basis. And when you're doing that assessing of potentially going back, look to see if you can use the credits and if you can document those expenditures. Put in place a methodology to use the credit starting right now. It's, again, we know there's big change. 1 year from now, you're going to be doing your 2016 taxes, and you're going to know alternative minimum tax is not going to be an issue for you. And so the way to get ahead of the game, as I said, assess to see if there's an opportunity for 2015. Whether there is or not, start documenting your activities right now. And so 1 year from now, if you've been one of those companies that's been prevented from using the credit and you're going to be able to use it next year, you're going to be ahead of the game. You're going to have a full year's worth of documentation. And even if you're currently claiming the credit, validate that the process you're using accurately reflects what is truly taking place within your company and allows you to maximize the opportunity. It's just like any manufacturing process. If your manufacturing process you develop is not, spot on, if it's not perfect, if it's not great, in the end, your customer may not end up taking the parts that you deliver to them. And it's the same thing with the R&D process. If it's not as solid as it can be, you're going to be leaving dollars on the table. So the bottom line is there's still a lot of dollars that are going unclaimed. This is not a tax shelter. It's a very valid planning opportunity. And even if you're claiming the credit, you may be leaving dollars on the table. And I want to wrap up today, and we have time to stay if people want to take questions. But I want to wrap up with a quote from Jeff Matthews, who's a CFO of Oberg Industries. Oberg is an NTMA member out in Pittsburgh. And you can see what Jeff says here. He says, our company has been claiming the R&D tax credit for a number of years through an internal process where we identified the costs as we understood them. We would then give that cost number to our CPA firm, who would then calculate the credit amount due to us. We had known a Blackline Group through our company's memberships and a couple of the same manufacturing associations and decided to engage Blackline Group for assistance with our R&D tax credit claim. As a result of their deeper knowledge and expertise of what truly qualifies as R&D, our company's credit amount was significantly larger than what we claimed on our own, and our processes and documentation to support our claim are substantially better. Our ROI from working with Blackline Group is measured in enhanced cash flow and has been very meaningful. The process has more than paid for itself many times over. So again, with that being said, I challenge people, if you're claiming the credit, look at your process. If it's internally led, make sure it's led by somebody that's an absolute expert and who understands this. And if it's led by somebody outside, make sure it's somebody that, again, really knows what's going on in your industry and with the credit. So with that being said, here's all my contact information. If anybody wants a copy of the PowerPoint presentation, certainly shoot me an email. I'll be happy to share that with you. And Rachel, I don't know, have you been looking at the questions? I see a number of them on there. Are there some questions that you would like to read and then answer?
Sure. I was looking at it a bit ago, so let me go back to...
Well, here's one while you're
Panel.
looking. One says,
Okay.
what do you mean the development does not have to be new to the world? Does that mean any development that's new to me is eligible? And Rachel did address this before. Yes, something. Well, no, it doesn't have to be Star Wars stealth fighter bomber type stuff that's never been seen. If your competitor is doing something that you're not currently doing and now you start to do it, even if your competitor is doing something and it's new to you, that qualifies. And again, as I said, every day, all those all those new parts and components that you get those requests from your customers, and you're doing some process development on each one of those parts, which again, you're doing every day. And by the way, it doesn't matter whether you get the job or not. It's not just the jobs that you win where the R&D counts. It's all the time that's also spent on those projects that you don't get. So, Rach, so you have another question there?
Sure. So just going down the list, and I think the next one is one that says, does tool and die design qualify dedicated tooling? And I think it's similar to any custom manufacturing situation, whether it's tool and die, if you're a prototype service, whatever type of custom manufacturing you're doing. The key is really, are you at risk and do you retain rights with your customers in that process? And if you are, then yes, then there's potential that that'll qualify. So definitely there's tool and die design activity that can qualify as long as the contract terms, put you in a situation where you have rights and you're at risk in the development. And then the next question says, is there some sort of documentation or spreadsheet available to track your R&D activities as you go throughout the year? And the short answer is, yeah, there's lots of different tracking systems available. Different ERP systems have those add-on modules. I know a lot of people use JobBoss. I know JobBoss has that ability. There's several other types. I could go through a slew of them, but there's lots of those that exist, and they do have the ability to do time tracking. What I would want to caution anybody on is trying to make the determination yourself on whether a project is qualified or not. If you get the hang of it, yes, you can probably do it, but generally, if you're not in the R&D tax credit day-to-day, you're probably going to forget how broad the definition is and what qualifies. So I usually encourage my clients to track all of their costs, and then we can help them identify which of all of what they're tracking would qualify. But there are lots of different time tracking, project tracking type systems that you can use for that. But that would be my answer to that question.
Yeah, and the other thing, in 14 years, we've never told anybody to go out and buy software to track their costs. As I said earlier, everybody has software programs today. The last thing you need is more software. And what I would tell you, what I know for a fact, because we work with a number of the ERP vendors, Rachel mentioned JobBoss, you got Epicor, they are more than happy to help you understand how to better use the software that they sold you. So if you have software and you want to really get more use of the functionality of the software, call that vendor and just say, hey, well, I want to do a better job of tracking my R&D costs, and I promise you they'll be very happy to help you, because as I said, they want to make sure that you're getting the most value from the software that they sold you. So, with that being said, we want to be mindful of people's time. So we will wrap up the webinar right now. But like I said, if anybody has questions, you can certainly contact us. If you want a copy of the PowerPoint, be happy to send that to you. And we'll get you information and help you figure out if you have an opportunity that makes sense to pursue. So with that, I just want to thank everybody for joining us today. I don't know, anybody on the NTMA side that wants to wrap this up?
Sure. Thanks, Scott, for your time, and Rachel, and thanks, Omar, for being part of it as well. We had a lot of people participate, so it was exciting to see everybody. It was nice to see everybody asking questions as well. I'm sure Scott can agree with that. And we've been recording this, so we're going to try and get that up on the website so people can share the link perhaps as well, and make sure you can always come back and check on the information.
All right, thanks, and have a great day, everybody. Bye-bye.
Thank you. Bye-bye.